Welcome back, my friends. The future of the oil industry keeps changing for a lot of reasons. Goldman Sachs just slashed oil price forecast by nearly 10% because Russian supply is recovering. Goldman Sachs lowered its Brent outlook for December to $86 a barrel, down from $95. The revision comes in spite of last week's announcement that Saudi Arabia is cutting production by another 1 million barrels per day, effective July. But there are a lot of moving parts in the oil business. For example, shale fracking is stealing the show as oil and gas spending surges. In Q1, U.S. shale attracted most of the overall increase in capex spending. Energy security concerns were one of the drivers behind this surge in spending. Are U.S. oil frackers finally getting out in the field and getting their rig counts up? Is U.S. oil production capacity finally going to reach its potential? What does this mean for consumers? What does this mean for energy markets? What does this mean for oil companies? What does it mean for the U.S. economy? And what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the healthcare professional knows the patient identity. Goldman Sachs analysts slashed their oil price forecast by almost 10% on the back of wave they see as increasing supply and slower demand for crude. According to a report released late Sunday, the investment bank lowered its Brent outlook for December to $86 a barrel, down from $95 a barrel. In the same report, Goldman also revised down its WTI forecast for December from $89 per barrel to $81. The revised projection marks Goldman's third downward revision in 6 months, and comes in spite of last week's announcement that OPEC kingpin Saudi Arabia is cutting production by another 1 million barrels per day, effective July. Overall, the oil cartel made no changes to its planned oil production cuts for the rest of the year. Significant supply beats from Iran and Russia have driven speculative positioning to near record lows, Goldman analysts led by the bank's global head of commodities research Jeffrey Curry said in the research report. Russia's oil production has remained resilient even in the face of Western sanctions, with Deputy Energy Minister Pavel Sorokin in April ascertaining that Moscow's oil production will remain stable until 2025, according to the Neftegazovaya Vertical magazine. The oil market is working against uncertainties, the Saudi energy minister said. After an initial sharp 1.5 million barrels per day drop, Russian supply has nearly fully recovered despite the decision by many companies to stop buying Russian barrels, Goldman's economists said. The bank made upward revisions for oil supply forecasts coming from nations facing sanctions, with 2024 upgrades for Russia, Iran, and Venezuela of 0.4, 0.35, 0.05 MB/d, respectively. While reports of an interim nuclear deal between the US and Iran have been described as false, market watchers have previously estimated that a successful agreement could see at least an additional 1 million barrels a day in crude exports. Hope of a US-Iran deal within grasp is one thing. But guarantee of a quick and unencumbered passage of such a complex, layered deal is quite another, Mizuho's Vishnu Varathan said in a daily research note. Goldman is of the view that the additional cuts implemented by Saudi Arabia are unlikely to result in a price spike, even as the kingdom's output will see a decline to 9 million barrels per day from around 10 million barrels in May. The extra Saudi cut and our expectation that OPEC Plus will extend half of its April voluntary cut in 2024 will likely only partly offset these bearish shocks, the report continued. International benchmark Brent crude futures traded at $73.99 a barrel, down 1.07%, on Monday morning, while U.S. West Texas Intermediate futures stood at $69.43, dipping 1.05%. If you have been following the oil industry recently, you probably know that fracking has been making a comeback. Fracking, short for hydraulic fracturing, is a method of extracting natural gas and oil from shale rock formations deep below the Earth's surface. The process involves drilling a well vertically and then horizontally into the shale rock formation. Once the well reaches the desired depth, a high-pressure mixture of water, sand, and chemicals is injected into the well to fracture the rock and release the trapped natural gas or oil. The sand injected into the well is used to prop open the fractures, allowing the natural gas or oil to flow more easily to the surface. The chemicals added to the water help to reduce friction, prevent bacterial growth, and dissolve minerals in the shale. Fracking has been controversial due to concerns about its potential impact on the environment, such as water contamination, air pollution, and seismic activity. Additionally, there are concerns about the potential contribution of natural gas extracted through fracking to climate change due to methane emissions during the extraction process. Fracking in the United States has seen a decline in recent years for several reasons, including economic factors. The decline in oil and gas prices has made fracking less profitable. When oil and gas prices are low, it becomes more expensive to extract them through fracking. Public opposition. Fracking has been controversial due to concerns about its potential impact on the environment and public health. Public opposition to fracking has led to regulatory restrictions and moratoriums on fracking in some areas. Regulatory restrictions. In recent years, some states and countries have implemented stricter regulations on fracking, including requirements for testing and monitoring of well water and the disposal of wastewater. Technological limitations. The amount of oil and gas that can be extracted through fracking is limited by the quality of the rock and the availability of water and sand. As a result, there are limits to how much oil and gas can be extracted from a given location through fracking. Overall, the decline in fracking is likely a combination of these factors, with economic factors playing a particularly important role. Global energy reliability concerns are triggering a surge in oil and gas investments. But this uptick is only temporary, and service companies should capitalize now before the focus returns to the energy transition. After Russia invaded Ukraine, expected investments in fossil fuels in 2022 and 2023 surged by $140 billion, Rystad Energy research shows. Before the war, the two-year total was projected at $945 billion, but as the war sparked shortages and sky-high prices, expected spending has jumped to almost $1.1 trillion. Of the $140 billion growth, shale production attracted most of the limelight with an additional $80 billion increase, as activity climbed 30% and pricing for oilfield services jumped nearly 50%. Offshore production accounted for $40 billion in growth, while other onshore activities expanded by an additional $20 billion. Service companies should make the most of this upturn now, while keeping one eye firmly on the future. The energy transition is not slowing down. Huge waves of investments in renewables and clean tech are on the horizon. So, to ensure their long-term success, service companies should adapt their offerings now to capitalize fully on the inevitable green revolution, says Auden Martinson, head of supply chain research at Rystad Energy. Last year's sudden need for more upstream activity through more rigs, more completed wells, and more greenfield sanctioning was so strong that the oilfield service supply chain could not meet the record demand for services and equipment that emerged in shale, offshore and conventional markets. As a result, service prices rose, and more than half of the additional spending so far has ended up as a 5 percentage point increase in suppliers' profit margins rather than as more activity. Energy security concerns have unlocked significant additional investments in oil and gas, boosting spending forecasts and sending the expected timing for peak oil demand out in time. The first wave of extra spending over the past 15 months mainly went to oil and gas, while low-carbon industries faced a slowdown due to high inflation and shortages in the supply chain. But low-carbon spending will bounce back, as energy security is not only about securing oil and gas here and now but also about securing cleaner energy for the future. The U.S. Inflation Reduction Act and the recently announced Critical Raw Mineral and Technology Acts in the European Union will strengthen the significant investment cycle brewing in the renewable and clean tech sectors. Solar, wind, carbon capture, hydrogen, and batteries are all markets that will benefit from supportive policies to accelerate low-carbon deployment and build up local supply chains. Gaining control of the supply chain is crucial for countries and regions to become less dependent on global value chains. Even though the sun shines and the wind blows in every country, the energy must still be harnessed and stored locally. The White House's top energy advisor Amos Hochstein called shale drillers un-American. That is because of their refusal to boost oil production. 10 years ago, Frackers always increased production when prices rose by even a little bit. But oil investors have been burned in recent years. They are watching how shale drillers burn their cash. Frackers turned the United States in the biggest oil producer in the world. Then oil prices famously crashed and went negative in 2020. Even though the drop was short-lived, it changed things for a long time. Now, 2 years later, it seems like a whole new world. Oil prices and shale drillers are different versions of themselves. No company is pushing the envelope to see just how much oil it can produce. Instead, shale drillers are teaching themselves capital discipline. Frackers are prioritizing their shareholders after, some might say, years of neglect. If you are watching the stock market, you know that energy stocks are the best performers on the stock market this year. And none of them want to rock the boat. The oil industry is blamed for high gasoline prices. Oil firm executives are blaming Biden administration's policies. Anti-oil rhetoric, inflation, contractor time delays, and regulatory uncertainty. Drillers were also scared by the risk of recession. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.